For more on what all this means for the markets, we are joined here at Post 9 by UBS Alignment Partners Managing Director Alli McCartney. Great to see you again. It is confusing because we've had a batch of strong data. We hear the consumer is slowing from the banks, and the market is sort of waffling between the soft landing, the hard landing, and the rate scenario. What are you telling clients?
Yes, so we are actually highlighting that sort of the binary nature of what's going on, right? You have one narrative that's driven by a lot of, and actually Brian Moynihan and a lot of the banks have pointed out both sides of it. You have this one narrative that's driven by, okay, rates are catching up to us, credit card debt's going. You know, he pointed out that middle income houses are starting to show signs of weakening. Then you have that other narrative, which is, but the consumer still goes. We just saw great retail sales numbers. We're seeing actually in the rear window, we have the earnings recession, so we think that's behind us and we're moving forward. So it is very much a confusing time, and I think ultimately the question is the Fed going to continue to drive markets or are fundamentals? Because what we're seeing in fundamentals are still very strong, both on the corporate earnings perspective and on the individual household. And remember, in the U.S., 70% of the GDP is driven by households, by individuals and their spending.
So would you tell investors that it's safe to be buying cyclical stocks like we're seeing today?
Yeah, so today is that cyclical day, and you're going to see a lot of them. And what you're seeing is the hedge funds get behind that trade, and a lot of the asset managers not. They're sort of leaning more into bonds or longer term. I think that there is a window for that, but I also think that we have to be careful in terms of what's expected. Most of the last 15 years for investors, the market was a beta trade. There were years that were FANG and years that were not. But in general, if you bought the markets, you bought the whole market. I think that that is not going to continue. I think you have to get behind, going forward, secular themes and laggards, because we do expect this to be a great earnings season and to start to lead into future earnings growth. And we do think that's going to be driven by the Magnificent Seven, but we also think that's going to allow them to grow into their multiples as opposed to shoot to the moon. So I think right now it's about balance. It's about balance between stocks and bonds. It's about balance between commodities and more traditional assets. It's about balance between private and public equity.
You talked about expectations. I mean, I wonder if you just pan out and say this, the stock market measured by the S&P has done nothing for 2 years, but it's given you 10-ish plus % over the past 5. Bond yields higher than they've been in a couple of decades. Not that crazy if you go farther back, but giving you some kind of an opportunity potentially in a portfolio, capture yield, maybe have an offset to equity risk down the road, and enable you to maybe hold more equity. So how are you telling people to try to think about that?
That's the right question, and it's a conversation that hasn't really been had in a very long time, again, going back to this sort of investor muscle memory, right? So if you look at what our expectations are, relatively soft landing, rates probably stay where they are for, let's say, another year and go back to this quote-unquote new normal of 2 to 3%, then basically what that says is we're about to face an environment where stocks, bonds, cash, and commodities can perform. Not only can they perform, but because there are different themes and narratives and tensions in the market, the other thing that can happen is they can actually balance each other out. So again, we're really trying to get people to do two things: be diversified and be discreet, i.e. know what they own, transparently own those things in separately managed accounts, so that, like we've been talking about with the banks, you're not stuck selling bonds because of temporary and technical interest rate movements. Know what you own in the stock market. Make sure you're more equal cap weighted than market cap weighted, and really just use cash as a place to deploy when those opportunities come up.